Welcome to the Morning Download Podcast, your go-to resource for personal finance, economics, and market insights. In just 8 minutes a day, we provide valuable information to help you make better money decisions.
Hey there, investors. So, it looks like fear is still the name of the game when it comes to the U.S. market. Not only do we have political tension adding to the mix, but there's also the looming risk of another interest rate hike. A lot of uncertainty for sure. Now here's a mind-blowing fact to start your day with. Apple, yes, that tech giant we all know and love, is actually worth more than the entire GDP of India. Can you believe it? It's pretty crazy to think about the scale of Apple's success and the economic power it wields. But let's get back to the market. The ongoing political tension and the potential interest rate hike are definitely causing some jitters among investors. It's a time where staying informed and keeping a close eye on all the economic indicators is crucial. Mortgage rates in the United States have reached a 23-year high, with the 30-year fixed-rate mortgage averaging 7.57% in the week, ending October 12th. This increase from the previous week's rate of 7.49% means that owning a home has become even more expensive. In fact, these rates haven't been this high since December 2000. Experts predict that these high rates will persist for at least the next 2 quarters, which could significantly impact the real estate market, as people are less inclined to make moves under such circumstances. Interestingly, the number of individuals with a net worth of at least $100 million has doubled over the past 20 years. However, this growth is expected to slow down due to rising interest rates. Many of today's centimillionaires accumulated their wealth by starting companies, funding startups, and even investing in cryptocurrency. Currently, the United States is home to the highest number of centimillionaires, accounting for 38% of the global population in this category. Meanwhile, conflicts and strikes are affecting various industries. Negotiations between the Actors Union and Hollywood studios have come to a standstill, as the former seeks higher pay, while the latter refuses to meet their demands. The strike by SAG-AFTRA, which represents around 160,000 actors, has been ongoing since July 14th. Additionally, the UAW strike continues to expand, now affecting Ford's largest factory in Kentucky, which manufactures essential vehicles, such as the heavy-duty version of the F-Series pickup and full-size SUVs. On a global scale, the ongoing war is adding pressure to social media platforms. The Asian market experienced highs, particularly in South Korea, where stocks surged due to Samsung's performance. In the United States, Microsoft finds itself embroiled in a $29 billion back taxes dispute. Earnings season has arrived, and everyone is keeping a close eye on it to see if it can give stocks the boost they need. The S&P 500 index has taken a bit of a hit recently, sliding around 5% from its peak in late July. But now, all hopes are pinned on earnings to turn things around. CNN seems to believe that this earnings season could be the stabilizing force that the market needs. However, Barron's has a different perspective. They don't expect earnings to cause a surge in the stock market, and we tend to agree with them. There's just too much going on in the world right now to instantly propel stocks to new heights. Analysts predict that sales for companies in the S&P 500 will be about 1.7% higher compared to last year. While this represents slow growth, it's unlikely to significantly impact the markets, especially considering the current environment of rising interest rates and geopolitical tension. The good news is that Wall Street seems to be aware of this. Estimates for per-share earnings at S&P 500 companies have actually fallen slightly over the past month by approximately 0.1%. So far, the reports coming in have been encouraging. Out of the 21 companies that have released earnings, a whopping 18 have beaten EPS estimates. This is definitely something to keep an eye on as earnings season continues. So imagine this. After laying low for 9 whole months, it seems that the mastermind behind the FTX heist is finally making moves. This elusive individual who managed to snatch a jaw-dropping $470 million in digital coins during the FTX crash is reportedly trying to cash out and convert the stolen funds into good old fiat currency. And get this, experts believe that a whopping $20 million of the stolen stash is being washed clean every single day. But here's the twist. No one really knows how this sneaky thief, or perhaps a whole gang of them, managed to pull off such a daring heist. Some folks suspect that there must have been insiders involved, because let's face it, this whole operation seems too audacious to be the work of a solo act. Now here's the tricky part. Authorities have managed to track down only a fraction of the stolen loot. Yeah, it's a tough nut to crack because, digital currencies are notoriously difficult to trace. But guess what? Some of the stolen Bitcoin has actually been sniffed out, and it seems that it ended up in the hands of a wallet associated with good old Russian-linked criminal groups. Looks like the plot thickens, right? Well, stay tuned to see how this daring saga unfolds. So, you're interested in finding out about the cheapest and most expensive metro areas in the US for single-family rentals. Well, you're in luck. A recent report by national real estate brokerage house Canary has analyzed the prices of single-family detached listings and identified the top contenders in both categories. Let's start with the most expensive metro areas. Topping the list is the trio of Los Angeles, Long Beach, and Anaheim in California, where the average rental price for a single-family home is a whopping $4,984. Following closely behind is San Diego, Carlsbad in California, with a price tag of $4,862. Other expensive areas include Naples, Immokalee, and Marco Island in Florida at $4,821, and Bridgeport, Stamford, and Norwalk in Connecticut at $4,750. Rounding out the top 5 is San Jose, Sunnyvale, and Santa Clara in California, with an average rent of $4,629. Now let's turn our attention to the most affordable metro areas. Leading the pack in terms of affordability is Little Rock, North Little Rock, and Conway in Arkansas, where you can find single-family rentals for an average price of $1,267. Following closely behind is Montgomery in Alabama at $1,394, and Birmingham and Hoover, also in Alabama, at $1,441. Other affordable areas include Louisville and Jefferson County at $1,492, and Cleveland and Elyria in Ohio at $1,506. It's no wonder that with such significant disparities in rental prices, about 40% of Americans are planning to move this year. However, it's important to consider the hidden costs associated with moving. Not only will you have to pay your agent, but also the moving company. Additionally, finding a new job in your new city can also come with its own financial implications. Keep in mind that moving might be more suitable for those who already have a job in the new city or have the flexibility to work remotely. If you're planning on making a move, it's always a good idea to do some research and familiarize yourself with any potential issues you may face when relocating to a different city, state, or even country. Knowledge is power, after all. I've got a great personal finance quote for you today from none other than Warren Buffett. He says, "Do not save what is left after spending, but spend what is left after saving." Wise words, don't you think? What Buffett is getting at here is that we often have a tendency to spend first and then save whatever is left over. But he's suggesting a different approach. Prioritize your savings first and then spend what's remaining. It's about making saving a priority rather than an afterthought. By adopting this mindset, you can ensure that you're consistently putting money aside for your future goals and financial security. It's a simple concept, but one that can have a big impact on your overall financial well-being. So instead of mindlessly spending and hoping to save whatever scraps are left, be intentional about saving first. Set aside a portion of your income specifically for saving and make it a habit. You'll be surprised at how quickly those savings can add up over time. Remember, it's all about making your money work for you and building a solid financial foundation. So, take Buffett's advice to heart and prioritize saving over spending. Your future self will thank you for it.
In today's episode, we discussed a U.S. market driven by fear and political tension, U.S. mortgage rates reaching a 23-year high, the ongoing earnings season with slow stock market growth, the FTX thief cashing out millions and authorities struggling to track digital currency, the wide variation in U.S. single-family rental costs, and Warren Buffett's advice to save before you spend, don't spend before you save. Thanks for tuning into the Morning Download, your go-to podcast for personal finance, economics, and market insights in just 8 minutes a day. Don't forget to subscribe for more helpful content and sign up for our free newsletter at morningdownload.com/subscribe.